On Monday, August 5th, 2024, Japan's Topix stock index fell 12% in a single day. The VIX, Wall Street's fear gauge, spiked above 60 in off-hours trading, a level seen only in genuine crises. And the news that supposedly caused all this? A mildly disappointing U.S. jobs report, released 3 days earlier in a different country. The Bank for International Settlements later wrote that the market reaction was wildly out of proportion to the trigger. That is the tell. When a small piece of news produces a crisis-sized move, the cause is almost never the news, it is positioning. Behind that Monday sat one of the largest funding machines in global finance, the yen carry trade. This is how it works, how it broke, and why it is back on the radar right now. Here is why this history matters today. On June 16, 2026, the Bank of Japan raised its policy rate to 1%, the highest level in about 3 decades, and signaled it would keep adjusting policy as inflation pressures persist. For most of living memory, Japan was the cheapest place on earth to borrow money, and that cheapness quietly financed positions everywhere else: US tech stocks, emerging market bonds, even crypto. Every rate hike in Tokyo shrinks the fuel supply of that machine. You do not need to trade a single currency to care. If your portfolio lives in global markets, some of your neighbors are funded in yen, and what forces them to sell can move your assets too. To see why, start with what a carry trade actually is. A carry trade is simple to say. Borrow in a currency with low interest rates, invest in anything that yields more, and pocket the difference. The yen was the world's favorite funding currency because Japanese rates sat near zero for decades. How big did it get? The honest answer from the BIS is that nobody knows precisely, but the pieces are telling. Speculators' short positions in yen futures peaked around 2 trillion yen, about $14 billion, a record. And that is just the visible tip. Yen loans to borrowers outside Japan reached roughly 40 trillion yen, about $250 billion, by March 2024. Broader offshore yen claims exceeded 80 trillion yen, around $500 billion. The BIS's rough middle estimate for the carry trade going into August 2024 was about $250 billion. All of it shared one assumption: that volatility would stay low and the yen would stay weak. Traders describe carry as picking up nickels in front of a steamroller. The returns are small and steady, right up until they are not. Here is the loop that turns a wobble into a quake. Volatility rises, so brokers and clearinghouses demand more margin. To raise cash, funds sell assets and buy back the yen they borrowed. That buying strengthens the yen. A stronger yen deepens the losses of every remaining yen-funded position, which triggers more margin calls, more selling, more yen buying. The loop feeds itself. In August 2024, this was not hypothetical. The Japan Securities Clearing Corporation raised initial margins on long equity index positions by 60 to 80%, and margins on short bond futures positions by 43% mid-episode. The BIS also noted momentum funds that had been short the yen flipped to long as the trend reversed, adding fuel. Nothing about the loop asks what the economy is doing. It only asks who is leveraged. Watch the timeline. July 31st, 2024. The Bank of Japan delivers what markets read as a hawkish rate hike. August 2nd, US payrolls disappoint, and the S&P 500 slips 1.8%. Then the weekend, then Monday, August 5th, Tokyo becomes the epicenter. Topix down 12%. Its volatility index at crisis levels. The S&P falls another 3%. Bitcoin and Ether lose up to 20%, as even retail traders meet margin calls. The Mexican peso, a favorite carry target, gets hit hardest among investment currencies. And then the strangest part, by that Friday, August 9th, the S&P 500 had recovered essentially all of it. The world did not change and change back in 5 days. Positioning did. That round trip is the signature of a leverage unwind, and the BIS closed its report with a warning. Only part of the trade unwound, and positions were already being rebuilt. The lesson is bigger than Japan. When the world's funding currency gets more expensive, everything financed with it gets repriced, and the selling shows up in assets that seem to have nothing to do with the yen. With the Bank of Japan now at 1% and still signaling adjustment, the interest gap that feeds the carry machine keeps narrowing. The things analysts watch are speculative yen positioning in the futures data, carry-to-risk ratios, and the pace of Tokyo's hikes. None of that predicts the next crash, and this is not a suggestion to do anything with your money. It is a map of where the leverage lives, so the next out-of-proportion Monday makes sense while it is happening. More breakdowns of the machinery under the markets are on the way. This is educational content, not financial advice.